today we're going to go through the Roth IRA versus the traditional IRA to help you figure out which one is better for you. And that's the key here. It's not always the Roth IRA with its tax-free income or the traditional IRA, which is reducing your taxable income today. It's sometimes a mixture. Sometimes it's one, sometimes it's the other. It doesn't even matter if you make a lot of money or a little money. This could affect you and your decisions all along the way, including small business owners, married filing jointly, single, head of household. It really just doesn't matter. So I'm going to start with going through an example, and then we're going to go ahead and jump into an actual tax bracket, just so you can put your eyes on it and really get to see how this actually plays out. So let's go ahead and start with an example so you can kind of see what I'm talking about today. And I'm going to start with an example of someone saving into a Roth IRA. And I already put some of the numbers just so we can go through it so you can get an idea of this. Now, here's where we mostly think about this. When we're looking at the Roth versus the traditional IRA, and you've probably seen this type of example if you've watched my videos before, but this is going to be the start of the example or the explanation. For the Roth IRA, let's say we're putting in $6,000, which is the max, and we get a 10 times return over many years, whatever, right? $6,000 turns into $60,000. Now, you probably already know the Roth IRA gives you tax-free income in retirement. So that means that $60,000, if we pull it out at any point, is going to be the full amount, because it's not taxable as long as it's in retirement. So the traditional IRA, looking at the same thing, we put it in at $6,000, we get the same investment. I put XYZ investment up there. Same investment here, same investment there, same exact return. We get a 10x return, but with the $60,000, we're gonna have taxes. Assuming that we're just gonna pay everything in the 22% tax bracket, that's gonna be $13,200, leaving us with $46,800. Now, yes, I do know that we have progressive taxes. I always get these comments. We have progressive taxes, so not all of these dollars, if $60,000 was your income, is gonna be at the 22% tax bracket. It's just an example to show you conceptually how this works. So clearly in this example, you would choose what? The Roth, right? Why? Because you're getting more money out of it. You're getting the $60,000 versus the $46,800. But there is a part that we're missing, and it's the beginning part. And what is that beginning part? You can see on my sticky note maybe down here. So let's go ahead and put that up here. In order to save $6,000, that means we're actually having $7,692. Why is that? Because we have taxes. And this is an after-tax contribution of $6,000. So if we're in the 22% tax bracket, that means we're really saving $7,692, where in this case, it's actually the full $6,000. And what's the difference here? Is that you're actually pocketing the $1,692 because you're not paying that in taxes today. So that's the big difference. Now, if we look at another example to show you a little bit different way of looking at this, if we're looking at the Roth IRA, and let's say we're gonna put in $4,000 into the Roth IRA, that means our $4,000 minus $880 for taxes, leaving us with $3,120. Because it's not taxed, $31,200, we get our $31,200. Same thing over here, we have $4,000. This is the way you should be looking at it, $4,000. Then we have $40,000. We're getting our 10x return in both scenarios, same thing as before. And then we're going ahead and subtracting our taxes. And look at that. We have exactly the same amount. So something to think about in this kind of a scenario that I think gets overlooked a lot. We think about getting tax-free income today, but what we don't think about is our current income. A lot of people who are just starting out saving, they're thinking, oh, I just can't get that money in there because my paycheck is just not big enough and I can't get the bang for the buck. So therefore, we don't save. So if it's really in that kind of a scenario, if you're putting it into the traditional side, then you're reducing your taxable income. And you might think, well, I just showed you an example where it's kind of apples to apples. I know it's going to be tax-free income, and I might be in a higher tax bracket later on down the road. Well, the truth of the matter is we really don't know where taxes are going to be at all in the future because laws change, tax brackets change, and our deductions, our credits, everything, the game changes periodically. So we can't always just be looking 20, 30, 40 years down the road. We also have to worry about today. And what else do we have to worry about today besides just reducing our taxable income by making the traditional contribution? Our credits and deductions. And I can't stress those enough that that is what you need to be looking at. The more money you earn, if you have a small business, the more important sometimes this becomes because we're dealing with even bigger credits and deductions. But even on the lower incomes all the way up to higher incomes or credits and deductions that you could benefit from if you just pay attention and do a little bit of planning to figure out if you want to put it into the traditional side versus the Roth side. Because if we can tip the scale at all, then it's going to make sense to put it into that type of retirement plan. And in this case, it's going to be the traditional side. Whether it's your IRAs or your 401ks, 403bs at work, doesn't matter. This is still having the same exact effect. So let's go ahead and take a look at this, and I'll pull this up on the screen so we can look at this together. And before we even go through that, let me just show you the 3 different types of credits that I'm just going to use as an example. So on the lower side, we have the Savers credit, and this is the 2021 numbers. So if you're head of household or married filing jointly, you can see the columns right here, or if you're single, it's all other filers over here. But let's say that you're married filing jointly and your adjusted gross income is below $66,000, then you would qualify for a 10% contribution credit. That means if you put $2,000 into your retirement plan, you get up to $200 off on your taxes, or basically the way you can look at it is $200 bigger refund. Or we can take a look at capital gains, which depends on how much you earn. So for example, for most it's at 15%, but if your taxable income is less than or equal to $40,400 for singles or $80,800 for married filing jointly, guess what? Your capital gains on money that's invested outside of your retirement plans would be at 0%. That's a pretty big savings. And then on the higher end, we have 400 and 200,000 income earners. So for married filing jointly, if you have kids and you're going with the child tax credit, that goes up to 400,000. If you're single or head of household, that is $200,000. So I wanted to show you that credit because it happens at every income level, because I'm gonna show you 35,000, and if you're not earning 35,000, you're gonna say, oh, this isn't for me, but it is, because it's at a lot of different income levels. So in this example, 35,000, if we put in $2,450 into our traditional side, not the Roth in this example, it's gonna reduce our taxable income, but it's also gonna give us a tax credit, because it's going to be the Savers credit in this case, which goes up to a credit of $1,000 based on a maximum of $2,000 that you've saved. So the example shows the Roth versus the traditional side. So illustrated a little differently, $35,000 the income for both sides, and we're gonna save $2,450 into the Roth in this example, and we're gonna save $2,450, the exact same amount, into the traditional side. So this really shows what the differences are. Now, by the way, this is just an arbitrary number, $2,450. I could have used $2,000, $3,000, I just chose $2,450. There's no rhyme or reason for that. So the total tax liability on the Roth side, because it has no effect in the year of the contribution, our total taxes will be $2,498. Whether or not we made that contribution or not, that would be our tax liability for somebody that's filing single, earning $35,000 in 2021. On the traditional side, here is the difference, that because we're saving the $2,450 and we're in the 12% tax bracket, that means we're gonna save $294 by making that contribution, but we're also gonna get the additional $200 tax credit, bringing our total tax liability down by $494, or total tax liability to $2,004. Again, $494 difference. And it's not that we can't qualify for these credits using the Roth IRA. It's the fact that the traditional IRA helped us reduce our adjusted gross income below $33,000, and that's why we qualified for the 10%. Therefore, it's really important to pay attention to your adjusted gross income and whether or not you need to reduce it in order to qualify for these credits. So what you want to do is figure out or project where your income is going to be at the end of the year, so you can start doing planning today and starting to educate yourself on the credits and deductions that might be available to you for your particular situation. And that'll give you some guidance on should you put more money in the Roth side or the traditional side. Whether or not it's an IRA, which is the example I used today, or your 401ks or 403bs, doesn't really matter. The concept is exactly the same, but it's for your particular situation, and it might be the Roth. That might be the best way to go for your particular situation, but it might not not be. It might make more sense to put a little on the traditional side and then flip over to the Roth side. It really depends on your particular situation. If you have any questions, let me know in the comments down below. And if you've enjoyed this video, be sure to subscribe, and we'll see you on the next one.